Hey everyone, welcome to another video. This is about Fibonacci's and how I use Fibonacci's, because I use them a little bit differently than most people. So I'll kind of show you what most people do, and then I'll show you how I do it and kind of explain the difference here. So I'm going to go into add an object, go all the way down, and you see Fibonacci retracement up top here, and Fibonacci area for MetaTrader 5 is what I'm in. You select the 100, right? And then you select a 0 point. And wherever the 100 is, so the 100, it measures the distance between 100 and 0. And mathematically, the difference between the 0 and the 100, it basically mathematically puts it into an equation, and then the difference, you get 161% of that difference, or 261% of that difference. So if 0 was truly 0 and 100 was truly 100, and you measured those 2 points, this point would be 161.8, if that makes sense. But instead, it's, as you see up on the chart, 0 is going to be 20.145 and 100 is going to be 19.9128. So very specifics, and then you'll get a projection that comes down here based on that difference, which is 19.758-ish. So yeah, that's basically a Fibonacci, and that would be a Fibonacci, what I call projection, because you're projecting out. A lot of people use Fibonacci's specifically for measuring like this. Not like what I just showed you, but what I'm about to show you. Let's see. Let's go right there. So most people use a 100 level at the top, and they'll put it down here, and they'll use this black line, move the black line to 61.8, and say that the trend started right here, the trend ends right here for whatever reason, and it's going to retrace down to 61.8. That's what they do in the stock market, and it's true. Stock market, what is that new one called? Fucking Bitcoin. Bitcoin, every single trading market, they use 61.8. The more amateur people, you go for 50, but 61.8 is a pretty firm one. 50% is, usually it's going to reverse and keep going up. So it's going up, it retraces down, and if it continues up, it's dictated by if it hits 61.8, it's going to continue up. If it hits 61.8 and goes back up, it's going to continue to go back up. If it hits 61.8, breaks, comes down, hits 50, it might continue down. Now, if it goes to 38 and hits 38 and bounces back, it can continue up, but not with a lot of momentum, most likely. Depends on what chart you're on, really, so that gets more complicated. But then after 38, if this retracement, so it goes up and it comes down to 38, if that retracement is hit and it goes a little bit below 38, it means it's most likely continuing down. And if it goes from 0 to 100 and then it comes down, it retraces down to 23 and it goes past 23, it's like a for sure thing, it's going to keep continuing down. That's how, my understanding, how most people use the Fibonacci's. This is how I use the Fibonacci's, okay? So that's what most people do, and you might agree, you might disagree. You're more than welcome to disagree. I don't use it that way per se anymore, because my technique is so specific, I don't need it anymore. This is how I use it. So we're on day one. Let's go to, so day one right here. Oh, my dog's coming in. It's a little bit harder to show you on the day one here because these are so sporadic, but long story short, if you want to project, let's say the top to the bottom, the ceiling to the floor, and you want to get that 61.8, right? There's more than one way to skin a cat, right? So let's get that line right there. That's what most people do, right? That's their take profit. Okay, sure. How do I find my take profit? Well, at the bottom of the trend, we still deal with the bottom of the trend. I look to see where that is on the bottom here for the RSI if you look below. So the bottom trend for the RSI is right here. So I'm going to measure the gap between the low point of the RSI at the bottom and the high point of the RSI at the bottom. But then once I do that, I'm also going to do the low point, high point, low point, high point, low point, high point, low point, high point, literally every single retracement, and it's going to build a ceiling. Not a lot of people do this, but the way that I do it, it comes out very consistent, and it's a 90 to 95% win ratio, so in my opinion, it's a very good technique. So with that being said, let's go ahead and measure those retracements. You have 100 on top when you're facing up, because you want 100 to be the base of the, this is the last trend, and that's the last little retracement, the last level that you have to go with. So you're going to project based on that last level before the trend, and then all the retracements leading up that trend also. So 100 projects the 161, the 261, and the 423. 423, if you're measuring a small trend, like let's say this was like the hour 4 chart, or the like the hour 1, hour 4 chart, and you get a 423, I would place, if that's an example right there. Let's go a little bit in depth actually and see. So hour 4. Set my face back up there. I want to say right there would actually be accurate. Let's go back up to day 1. 423 would be right here. So I'm just going to set that as a green. That's not really significant, but I'm just going to measure everything just to show you it's important to measure everything. It's going to set 100 back up there, and we're going to get a 161. So I'm going to set another one right there. And right now I'm trying to project that ceiling. I'm trying to show you that before this trend happened, I would have projected this ceiling and saw it coming. And then once you project that ceiling, you know where that ceiling's at, you know it's for sure retracing once it hits that ceiling, within a 5% margin of error. As long as you listen to all the confluence indicators that are down below, and the Bollinger Bands, and blah, blah, blah. So we got that. We also have another line, which would be the 261. I'm leaving this black, by the way, to show you what basic people do, and then what I do, so I could show you the difference. So all these are just going to be green. So next, again, I'm going to go based on the RSI, but I already know how to look at the chart up here and know what to measure. So I know I need to measure the top of this and the bottom of that. Close enough. Let's actually have it be 100% accurate. There we go. So I'm starting to build a ceiling, what I call the black bar ceiling and the red bar wiggle room. The red bar is where the candle will typically cut on the bottom, and the candle tail will go up. Whenever I see these two really close together, generally speaking, I'll see a candle split right here, and then the tail will go up to the black. We're just starting to do the measurements, so I already see what's happening in the present, because we're not doing a live chart right now, and I can't show you that I'm predicting the future. But you see a confluence indicator right now, confluence in Fibonacci's, is 261 is the same spot again. So I think the last one we measured was a 261, and this was a 261 again. That's a good sign. That means it's a very firm floor that's being hit right there. We're going to have that be a dark green just to show that we're adding layers to that. For some reason, that's a really confluent Fibonacci right there. And then right there. And then we're going to come down. And then we get a 423. The 423 is usually, like I said before, when you're measuring a very small distance on whatever chart you're on, if it's a very small distance, usually you get a 423 on your same window of your chart. There we go. So we got a 423. That's now that I see, if we would have been back here in the past, right? 423 would have been way up there. I would be happy, honestly, with a gain from right here to up there. But we're looking for the actual ceiling. So as it goes up, we would see that, it might hit this, but there's another Fibonacci that's popping up right above it. So most likely it's going to go up there. So would I actually start a retracement trade right here? Well, if I get a 423 that's right above it, I probably don't want to do a retracement right here, because it's most likely going to candle break somewhere around here and candle tail somewhere up here. But again, we do more measurements to find out. So we're going to go a little bit further. And oh, hey, look, we get another red and black line. So there might be two areas I might trade in. I might trade in right here, and I might trade in right here. So that's something to look into. I got a 423 on top, so I'm going to put that as a black line. I'm imagining that I'm doing this live, and this hasn't happened yet. Hour 4. So we're going to go right, I can't see. Right there. And I think that's it, but let me go to the hour 1 just to make sure. Damn, we're getting another 261. So again, this is all before these levels pop up. These are the levels that I'm getting so far. So I just want to be honest about it. About what I'm seeing. Okay, so right there, and then we see another little one right there, probably a 423 will pop up. And as it's going live, you keep doing measurements. Uh-oh, look, there's another 261. That's probably the for sure ceiling right there. This is probably just a distraction, but you notice it might not be a 100% distraction if you're trading live. Something to pay attention to. The market, you know, going from left to right, of course, live, it goes up on 2 candles over. Let's do that right there. It comes up, it breaks through this, you know, temporary ceiling, and then it comes down. Where does it come down to? This other level that we measured. That's interesting. If you were trading live, you could have went to the minute 15, and you would have seen a little bit more accuracy in that. Where are we going? We're going back. I don't want to get lost in there. I don't want to go off on a tangent either, so let's try to stay focused here. So we're trying to project the ceiling. I see a 423 up there, so I'm just going to mark it. This is what this is about. You just keep doing a lot of markings. I like to go to the top of 423, but then I go down a little bit to the middle of the 3. I like to go a couple pixels down. That's just what I like to do because it's a little bit safer if your spread is 5 or 10 pips. It depends on how big your screen is and how much volatility there's been. But you always want to go down a little bit away from the maximum possible profit because you want that wiggle room to actually get into the trade safely if you're doing it automatically. Okay, so, and if it continues to go up, you would continue to measure. So let's say it's live and we see it continue to go up and it hits this ceiling. We measure right here. But also, is it hitting 90 down there? Oh shit, it is hitting. Oh, where'd it go? Like, oh, is it hitting 90? Oh, it is hitting 90. I would go to the upper chart and see if the RSI is making a gap. Again, my whole technique, I would see if the RSI is making a gap. And if the RSI is making a gap on the upper chart, meaning the RSI is 85 or higher and the moving average is still down low, there's a gap. That means it's due to retrace. So that would be a tall tale sign. I'd be like, oh, this is when it's reversing. Most likely it was like 60 at this point, but there wasn't a gap. It doesn't look like there's a momentum gap happening right here anyways. So I most likely would have been like, I don't feel comfortable doing this trade yet. So I would keep projecting up, personally. And then I get that 161 up there, and I'd be like, okay, well the 161, it keeps climbing, so okay, whatever. So that's a new ceiling, and again, it's a confirmation. I've already had that level up there, so it's 161 again. So I'm gonna make that black, I guess, now. And go to the day 1. That's about all that I could do. Let's see if I can go to the hour line. Maybe one more when it goes to hit that black but doesn't quite hit it. See if I could project that ceiling. Maybe the ceiling hasn't been hit yet, you know? Maybe I'm not measuring high enough. Oh, hey, come on. So there's that 261. So I'm starting to see that the levels are being hit. The candle bottoms are touching. The candles are splitting on the lines, and the candle tops over there kind of touching the lines. So I'm seeing truth in it, but honestly, this isn't looking like a 100% trade to me yet. Let's go down a little bit more on the chart to the hour one. Right there. So we get another one. I couldn't see what this looks like live. For me, what really matters is when these set up appropriately. And I see the RSI came up and then it came right down. It didn't come up together really gracefully, and I wouldn't get into the trade personally. So this is a good one to show you that like sometimes you want to get out of a trade. It would look different live again because it's averaging the current candle and the past two candles, whereas if you're looking at history, you're looking at the candle in the middle and maybe the left and the right, or the candle in the middle and the next two. It's averaging, past and future, whereas if it's live, it's present and past. So the RSI down here looks different, and the chart up here looks different for the moving average also. So it looks a little bit different live in historical vision too. So hour one, that's about all the measurements. And as soon as it comes up here and it touches up, I would do that one too. And that one, and then I'll get another 161, but this would actually look pretty promising. Because remember what I was saying, you get those little, you get the black bar on the top and the red bar. So let's say I call that a red bar. And there's no more projections I really could do. I can go on a smaller chart and nitpick it if I want to. Then when I expand it out, I see that I've come a long way for sure. I would go look at the day one chart and see if there's momentum building up. And I would see that, it is bubbling up to a point. So on the week one, I need to see a gap. Oh, awesome. On the week one, the RSI over there is 95. It should be 85 or higher. And there should be a gap between the RSI and the moving average. There is. So there is a retracement due for sure. And it looks like if you look up, there already was a retracement that already happened. Because we're late to this trade. We're talking about something that's already happened. But if you would have been measuring this whole time like we're talking about, remember how I was saying pretend that this is a live trade? We would have projected that ceiling. Now, it did shoot through the ceiling, which is fine. It just means there's extra emotion in the market, and the banks have these levels, but then humans shoot through the levels. So if we zoom in, you could see what was respected. Almost every line that we made was respected. Specifically this area, this trading area was respected. But you want to clear all of these, and whatever your gut instinct is on your red and black line, you go with that. So I was getting lots of confirmation, double 261s, double 423s, 161s. I was getting all of them projecting up there. And I think, the 161 was the retracement. So now let's do the retracement. Now where's it going to go to, right? Let's leave that line because it looks like it's pretty significant. Let's leave it. We'll delete it. So let's project on the way down. So that was the bottom profit, right? So let's go to day one. Top and bottom. Were we on day one? I think we're on day one. Man, I barely remember what we were doing here. What the heck were we doing here? Oh, that's week one. That's why it looks so weird. There we go. Day one. So we projected and we basically got that ceiling. So remember, we projected up here and we slowly projected as it was going. But it looks like this market might have been controlled more by people than by banks because it looked a little chaotic, to be honest. And then we eventually got up here, and we predicted this ceiling that happened. There wasn't much more happening above it. And most of all, our hour 4 charts were starting to hit a 90 overage. If you would have been, just to give you an example, if you would have been right, let's see, it's really hard to go with past history because it always looks like it's at 90 when you go in the past, but live, it looks totally different. So like right there, it could have been a retracement. What's going to happen right there? You could have did some Fibonacci's of all of these little RSIs. You do a Fibonacci of the low and the high right here, and there, and there, and there, and there. You see where the ceiling is, and if the ceiling was right there, you probably could have caught a retracement. Look, there was a little retracement. But it's up to you to go to the upper chart and say, is there a gap? And if there isn't a gap, like let's say the moving average and the RSI are really close together, then you want to wait, unfortunately. Try not to do the trade then, because if the moving average and the RSI are close together, that means very strong, slow momentum is building up, and you want to wait. But when you see a gap, like the week 1, that's really good. That means the momentum's going to come down. This candle hasn't broken yet for the week 1. The week is about to start on Monday, so as soon as that starts, it's going to come down a lot, and it's going to look totally different. You're not going to see that gap anymore, but you could have predicted the gap if you were doing Fibonacci's. So day 1, we got that ceiling. Long story short, with Fibonacci's, now let's project down to see where the profit might go, and if we could still get in this trade. Maybe we could still get in the trade. So this is my mindset with Fibonacci's and how I use it. So remember, it's 61. That right there is that's week 1, day 1. So we're going to use, remember, Fibonacci is how a basic person would use it, top to bottom here. And a basic person would say 61.8, my take profit is going to be right there, right? That's what a basic person would say. This is what I do. So we're going to go to hour 4, go to a smaller chart. Again, look at the RSIs down there. We're going to go the high to the lows, and we're going to project down. We're using 161s, 261s, and 423s yet again. And let's see. Oh, the 161 says it's going to come down a little bit lower. Well, and let's see. Let's make it green. Black was the original. We'll do green for our made take profits. And right there. And then we're going to get a 161. You want to go a little bit above it, though. I always like to go a little bit above just in case. Like when I set my actual take profit, I set it like a good gap, like 10 pixels above it, because I want to be safe. That's not enough Fibonacci's to measure up high. You want to do like right before it turns around up here, you want to do as many measurements as possible. So we're going to go to the smaller chart, and again, look at the RSI down there. What's a good thick RSI to base off of? I'm going to do that one. And we get a 161 right there. So again, you project all these lines and you start to look down to see what makes sense. So again, we're trying to face down. We're trying to see if we still have skin in the game. Let's now assume what the reality is, which is we're late to the trade. And let's see if we can project if there's any more skin in the game, or if we have to wait until it starts to go back up more, or see if it's going to go back up more. So hour 1, let's go to the hour 4 to see if there's any more. So there's another 261, and same thing with the black and the red line that I was talking about before. If you see a wiggle room, a gap right here, that's usually a good indicator, and that one hasn't quite got there yet. But if you look down here at a live chart, you could notice the RSI, the moving average and RSI are really high up here, but there's still a gap. There's still some room for the RSI to pull down the moving average. But again, if you go to the day 1 chart, what does it say? It says it's retracing and coming down. Okay, so let's go to the week 1. Oh, the RSI is really high, so the market is really high, but the average pace, the moving average of the market is really low. So most likely there's going to be a big retracement. So if we go back to the day 1, we see that there's an overage. Okay, so it is going to be coming down, probably aggressively because it's a day 1. And then the hour 4, we see that it already hit the ceiling up there where we predicted the ceiling. Okay, so far so good. And we're trying to project where the retracement floor is. So not the floor where it's going to drop to, but the retracement area. So like the chair or whatever metaphor you want to use. So that's what we're looking for. Where are we going to take profit? There's a 423 down there. Let me set another one down there for the 423. Right there. So we go back down to the hour 1, and then once it starts to come down, I'm going to measure this one too, because this one looks like it's going to be a little significant also. So there's a 261 right there. So take profit if you just started at the tip top. It looks really positive, like it's going to go there, and look, of course it did go there. Oh, and then see if there's a 423. There's a 423. And lo and behold, if you would have listened to the 423, that is exactly where the take profit for the current trade is. But is it going to go further? Well, what we looked at and just talked about says it is going to go further. So let's keep diving down. So far it's been pretty accurate. Now we're going to move forward a little bit. and I'll show you why. So let's delete these ones up here, because I showed you that we projected this little retracement area, like it's for sure going to take profit here, and then before it hit that take profit, we projected this bottom, which ended up being the candle tip bottom right there. So let's just move down, move further, because let's work with the current trade, right? And then we'll do that one too. Okay, so now we have this floor projected. We have all these things down below projected also. Let's kind of look in the more recent history. So let's do a Fibonacci super fast for right here. Let me show you what they look like in Confluence. It might click in your head once I show you this. Like, oh, I see what he's talking about. So we got the 161. No, let me do it later after I show you this. So no, hour 1 right there. Gonna measure that. This might be a long video, but honestly, the Fibonacci's are the most complicated part, and this is where I lose most people, and they're just like, yeah, your technique is really accurate, but it's just so hard to do. Like, there's so many measurements. It's like, yeah, dude, you gotta work a little bit. It's not free. So we're doing all these measurements. Get the bottom right there. Okay, now we're gonna deselect them. Boom. Go to hour 4, and now we're gonna see all of. So this is what I usually do. I'm sorry I didn't show you this first, but see 261, 423, 161. On my Fibonacci's, it says you want to look for, on my chart it says you want to look for a Fibonacci large 161. So you're measuring a large distance. Where's the large distance? That would be that big one in the middle. It's a relatively large one, and then a relatively smaller one first. The smaller one projects to 423. The larger one projects at 261, and the most recent super large gap, the most recent one, this guy over here on the side here, this one right here, that one is projecting a 161. Generally speaking, the most recent gap is going to project a 161, but not always true. But look, we have a 423, a 261, and a 161. We have the whole shebang. So that take profit, where like a layman would just be like, oh, it's going to go down to 61.8 and retrace. Honestly, that's we can entertain the idea that down there on the bottom might go to 423 or 261. Do I have confluence and Fibonacci's? Do I have 3 Fibonacci's down there? No. So I'm going to erase these. So the layman, the basic top and bottom measurement, 61.8 Fibonacci's, ended up being correct. And this is how I would know, 423, 261, 161, because I went down on the chart and I measured every single back retracement that looks significant. Let me even do this one too. It's too small to be significant, I think, but let's see. That is so tiny. Yeah, it's too tiny. Let's do that one. Let's see if that one's confluent. Go to hour 4. And yeah, we're gonna get that floor that created the first little RSI retracement. See, so the RSI, like I said, the upper chart or the lower chart, this is the hour 4. Let's say that it was an overage state on the hour 1 right here. This would be the hour 4. So the moving average would be way the fuck up there, but the RSI would be at looks like 70 to 80 right here. That's a gap. So that means the hour 1 is retracing back, and that's what you see here. You see the hour 1 at 10 down here, and then the hour 1 going back up to 90 up here. And once it's at 90, it comes back down, and that's what you're seeing right here. And then eventually, like 2, 3, 4 hour 1 overages turn into 1 hour 4 overage. Same thing. And you'll go up to the day 1 chart, by the way, and you'll see the day 1, there's an overage up here, and there's an overage down there on the side there. But in between, this is an hour 4 overage. Oh, shit. This is a second hour 4 overage. That's probably an hour 1 overage. That's probably an hour 1 overage. And then you get an hour 1, an hour 4, a day 1 overage, all right here, right now. So if that makes sense, hopefully that's making sense. We're going to go back down to hour 4, and we're going to see, okay, so we're getting a 423, a 261, a 161, and then of course the 100 where it actually stopped. So again, we're getting confluence in there. So if you would have been projecting from, again, it's from history, so the past doesn't predict the future, but it really helps project it. So this would have been your take profit. If you were at the tippy top and you projected down, you'd be like, oh, that's take profit 1, that's take profit 2. And long story short, that's how I do Fibonacci's. So take profit 1 is there, take profit 2 is there. Should I get in the trade right now? Well, the RSI isn't down low, the RSI is up high. But you want the RSI to be up high so you can buy in on this dip coming down again. So it might actually be smart to buy in right now. You can go into the hour one. The hour one's not quite at an overage state. The RSI just met down with the moving average, which means the RSI is going to pull back up a little bit more, most likely. Is that true on the hour 4? Yeah, the RSI could go up a little bit more to meet with the moving average, maybe dip up a little bit more and then tank down again. So the hour 1, minute 15. I mean, I can't do the trade right now because it's Friday night, so I can't even place the trade. I wouldn't be comfortable doing a 5%, which is my maximum, 5% of margin. So if it's like $1 million account, leverage 1 to 100, have $100 million, I wouldn't do $5 million. I wouldn't do a $5 million leveraged trade. I would do like a $1 million trade. It's like a 1% risk. Because I would want that wiggle room, you know, like I was saying, like it could still go, it could still go up a little bit, you know, all that stuff. You want to do lower risk. If it seems risky, you want your leverage to be lower. If it seems high risk, like, oh, there's still a lot of wiggle room there, then you want it to be low. If you have a 5%, 10%, 20% trade, marginal trade, 20% of your accounts at risk, that's just stupid, because if it goes up 5 pips, you're out. If it goes up 10 pips, you're out. Or, you know, how many ever pips it is for this circumstance. I would want it to go to at least, and again, how you could use Fibonacci to predict this. Okay, so how high can it possibly go? Let's find out. So let's close that out. Let's do some Fibonacci's. Literally, once I see an overage setup, I use Fibonacci's fucking nonstop, seriously. So again, we're gonna just do a bunch of Fibonacci's, and we're gonna see if we're gonna get confluence within the Fibonacci projections and see if there's a good spot. So we get a firm area right here. We get another firm area right here. Let's make these, like, I don't know, yellow for entry. And then as soon as it comes over here, because we are dealing with this right now, we're going to get another 161 and 261 up there, then another projection right here. Right there. All right, so then we're going to get another level right there. We're going to go to the hour 1 to see everything. Yeah, 261, 423. I mean, it kind of did hit right here, but as far as, like, does this have momentum for the moving average to come up and have a candle split up here? Not just a candle top, but have a candle split up here? I think so. So honestly, the stop loss should be like right here, you know, above that line. You want the stop loss to be a little bit above it. So what is that? That's, what are we on? Oh, Mexican peso. So 3 back, I believe. So 131. Oh, I can go to 145. That's 15 pips. But from where we're at currently, that's still pretty far. So, I mean, I would prefer it to go back up a little bit more before I got in. But if I'm getting a take profit, let's go back and see where the take profits are. And let's clear the Fibonacci's, just because they look ugly now. There we go. Okay, nice and clean again. Let's see. So we're going to enter on yellow on preference. Enter on this. That's the stop loss. This is the stop loss. So come on. Stop loss have to be like blue. And then I would want to enter right here, around there, preferably around that yellow. Let's have the black and red that I was talking about, remember? Let's have the black and red be here. So if it hits red, we're good. If it hits black, that's like kind of the maximum you want it to go up, because it's probably not going to retrace up more before it goes down. Go to the hour 4, and we see that their take profits are right here and right here on the way down. You know, to get this moving average to pull down, the RSI is going to get that extra momentum to pull it down. It's going to pull down to take profit 1, which it already has, and take profit 2 is next. The only question now is it going to retrace a little bit harder or not? You could do a basic RSI, a basic Fibonacci like we did before too, 0 to 100. And look, the red line is 61.8, but the red line was already hit. So that's, you know, your own judgment. Is it actually going to go back up there or not? Blah, 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 blah. So yeah, do you get in now at the middle, or do you wait for it to go back up? It's already hit that level, so you're already late to the game, to be honest. You're already late. So getting at the middle, low risk, and then going down, is it worth it? Let's see. So in my opinion, I always want to be one reward, half risk. So if I'm gaining 100 pips, I want to maximum lose 50 pips, basically. So take profit 2. Let's go with history real quick and see. Yeah, that's decent wiggle room. Black line, green line. I'm trying to see if that's a good level. I would maybe want the take profit 2 for safe reasons to be on that line. So I don't want the take profit to be like right there. Yep, that's where the edge of the box was, and that was just a rough guesstimate there. So the take profit will be 19,789, and the stop loss be 145. We're at 2039 right now, so it's basically losing 100 pips or gaining 935 would be 100, 835 would be 200, 250. So I'd be gaining 250 pips or losing 100. That's better than 2 to 1. So yeah, I would open up a trade, not 30 lots, because that would be $3 million. I would do a $1 million trade. So I would do 10 lots. Boom, 10 lots. My take profit would be, what was it, like 19.789? It's like 825. My stop loss would be 20 point, I think it was 145. And then boom, I would hit sell, and I would buy a sell trade. I'm not, because the market's closed, of course. But yeah, so I could go ahead and come back to this in the future on like Sunday when the spread is crazy. That's the thing too. When Sunday starts, you might get a gap in the market, so you got to be careful. That's why you want to use 1%. You might get a gap in the market. So when Sunday starts, the market might be here. It might jump down here, and the market might even jump all the way back up there again. You don't know, because that's a dark pool. That's, you know, the hedge funds and the people who are transferring billions of dollars for a transaction. They're dropping the yen for, you know, the Russian, or they're dropping the yen for the dollar, or they're dropping the Canadian dollar for the peso, whatever. Their business needs to transfer money into a different currency, or business is being sold and being bought in Switzerland, so it'd be using like the Swiss franc or whatever. So are they going to buy the company with the Swiss franc, or are they going to buy the company with the US dollar? You know, it's all kinds of complicated stuff. But basically, like, is there going to be a dark pool gap in the market, and is it going to be positive or negative? You don't know that. It's really hard to predict that unless you have the back end data from a dark pool. So with that being said, that's how you project into the future. So I don't see the future, but do I seem less confident? Not really. I'm still pretty confident it's going to be coming down here. The only thing I'm not confident in is because we're range trading. We projected that top. We predicted that top right here in that wiggle room. We predicted it and projected it, but we weren't live, so we didn't get in the trade. So instead of being at the top, or instead of being at the base, we're in the fucking middle. So you got to live with that. If you want to do this trade, you could do this trade, but you need to not have 10% or 5%. You need to have 1% because your margin of error is much bigger. So your margin of risk needs to be smaller. But yeah, that's how I projected the ceiling. The first take profit, the second take profit down here, and weighed the risk of should I get in when it goes up a little bit higher or when it comes down lower. Well, it's already been up high, so I might as well take the risk because I would lose 100 pips, but I would gain 200 pips. And let's do the math too. On $1 million account, just for risk purposes, for a lot, it's pesos, not $10, it's like $5. So 5 times 100 pips, $500. Really? Seems really low. Oh, but it's 10 lots, so 5,000. I would lose $5,000 by losing 100 pips, or I would gain 10,000, 12,000. I lose $5,000, or I gain $13,000. I think I'd be happy. Or actually, you know what? I did it. 789 was where I was supposed to go, so like 19,800. So I'd actually probably make like 15,000, probably close to there. Nah, let's just say like 13,000. So I would lose $5,000 or I would gain $13,000. Is that worth the risk? Well, according to here, it is worth the risk. You want 1 to 2 risk. So you want to win 2 and lose 1. You know what I mean? So you're always up ahead. You statistically always want to be up ahead. You want to win more than you lose. And when you win, you want to win more than you would have lost. And that's how you end up winning, mathematically. And on a risky trade here where you're in the middle, you're range trading, you want to make sure that you're low risk, not high risk. Low leverage, low margin, which would be low risk. But if you're high margin right now, a high percentage of your accounts, that'd be risky because that's 100 pips. 100 pips on, times 10. So instead of using $1 million or 10 lots, let's say you use 10%. That'd be 10 times more. So instead of losing $5,000, you'd lose $50,000. And instead of, that's a decent amount of wiggle room. That's only like 5% of the account, really, 4% of the account. Actually, I'd be fine doing a 10% trade. That's not even that big of a deal, because I would be losing 4%, or I would be gaining like 10 or 11%. So I can gain 10% of my account if I traded with 10%. I could gain, sounds like 1%, right? Like $12,000, and I have a $1.2 million account right now, demo account, not real money. But if I have a $1.2 million account and I gain $12,000, then I would just gain 1%, basically. But if I trade with 1%, I gain 1%. If I trade with 10%, I would gain 10%. So I'd basically get back the money I invested, so to speak. So I'd actually be fine with that trade. I don't see anything wrong with that trade, As long as the chart analysis was fine, I'd be okay with that. But since I'm range trading and it's not like maximum profit, like what if it blows off steam and doesn't get all the way there, I would lose out. So I don't like that. I like to get in at the top and get out at the bottom, but before the bottom. Like I said, this could be the bottom. This is the 61.8 firm, and this is the more comfortable signal candle comfort level. Get out, take profit. So there's that wiggle room. There's that, like, you better be watching the chart, or just have it automatically get you out right here. Because remember, like, if you're down here and your spread is up here, you need to get down here for it to take profit. So that's why I always choose to go a little bit above, because if it comes down and it only goes right here and my spread is like 20 pips, I get out like right there or something like that. So we're good. So that's how I use Fibonacci's. Sorry I went on a tangent. Ended up being a 45-minute video, but honestly, Fibonacci's can be a little bit intimidating the way that I do them, at least. It might even be confusing. You might even say, that doesn't even fucking make sense. But you know what? I predicted that ceiling, so if you can talk shit all you want, but I predict the ceilings and I predict the floors and even the take profits. And people do that with harmonic patterns and software and all that bullshit. I just do it with my simple techniques, so it works for me. If you want to try it out, you're more than welcome to try it out, but these are how I use Fibonacci's. Thanks for watching, and hopefully you found something useful with the video.